Welcome investors. The Fed's favorite metric for inflation, which is PCE, comes in slightly below expectations. Does that mean the Fed is going to cut rates sooner rather than later? And then tragedy strikes the Francis Scott Key Bridge in Baltimore. What ramifications can that have on the markets? Let's get right into it. And we're going to take a look at some data here. So in this column, we have the actual data reported. And in the second column over here, we have the consensus, the agreed upon potential number. So first, core PCE, which is inflation excluding food and energy, actual 0.3 month over month, expectation 0.3. Consumer income, which is inflationary, we had 0.3 and expectations of 0.4. So a little bit below the consensus there. And then spending's still staying hot. Consumers are spending 0.8 instead of 0.5. If we include energy and food prices, we got 0.3 and the expectation was 0.4. So core PCE came in as expected, 0.3. And then another inflation driver is personal incomes. So if people are getting raises consistently, they can spend more money, and that causes a wage price spiral, and that's something the Fed does not want to see happen. But the incomes came in lower than expected. That shows inflation is, in some aspects, again, declining over time. Is it as a negative? No. It's still above the target range for the Fed. But they said they're not going to wait for inflation to come down to their target before they cut rates. What are they going to wait for? And why are they predicting 3 rate cuts this year? I want us to take a look at something so we can understand this a little better. The Fed funds rate. This is what they control when they're saying, hey, we're raising interest rates, lowering interest rates. The gray areas are recessions. Started to 55, and what happens? Fed's raising interest rates, and then boom, they cut very quickly. Fed's raising interest rates, they pause until we get a recession and then major cuts. Here's the one in the late 60s where we got a soft landing. The economy wasn't really weak. We didn't have extreme problems with energy and supply issues. 70s, pause, cut. Mid-70s, which we had an oil crisis there, cut right away. 80s, same theme where we cut really quickly. It's not this drawn out 25, 0.25, 0.25. Big cut, early 80s, and then mid 80s. We did have a cut, but no recession. What did we have in the 90s? We had a mild recession there. We cut, and we were able to pause, but we weren't fighting massive inflation like we are right now. And here, what are we getting to the 2000s? We get a really big cut. The pause, big cuts. Coronavirus, that's quite a bit different. That's kind of a one-off black swan event. Well, you can see with the history of the Fed funds rate when they're raising interest rates, and especially something like now where we're fighting inflation, they had to raise it at a historic rate, a rate that we haven't seen since the 80s. They typically don't cut rates slowly and drawn out. I mean, there was 2 times where we had the soft landing, and then that mid-90s, which is just not the same time period that we are today, where we're not fighting inflation, we're not fighting supply chain issues. We had we had Desert Storm then, we're fighting a war in Iraq and actually bringing down energy prices during that time frame as we took control of a lot of the oil fields, and there was a battle over in the Middle Eastern countries. It's a much different time period than we are today, but we can clearly see if, maybe 3 times through history of all the recessions that they were able to, and not necessarily bring down rates slowly, but maybe more pause and just keep them level, and then a few years later, then they had to do the big cuts. Or, we're in the 60s, we didn't see a decade before the big interest rate cuts in the 70s when we had a big oil shock. But again, that's quite a bit different time frame than we are today. So I would expect them, if they're going to start cutting rates, look for them again, nothing is guaranteed, nothing is set in stone. All we can do as investors is put probability on our side. Make it the highest probability investment that we can. And that's usually how we come out on top. Not going to win everything, but we can be right more often than not when probability is in our favor. So what does probability favor right now? Probability favors if they're going to cut rates, they're going to cut rates quickly. However, we have some other variables happening right now, and some other variables are going to happen this year. Obviously, we have a political election and geopolitical tensions, and another really grave tragedy that just took place, the Francis Scott Key Bridge. Condolences to their family, absolutely terrible. So I'm going to pull up an article. We need to understand the potential ramifications of this Francis Scott Key Bridge collapse and what can be the fallout to markets. But before we do, if you're finding value from this video, be sure to like the video and subscribe to our channel so you can stay ahead of the curve. Let's get back into it. Okay, so I got a Forbes article up here, how the collapse of the Francis Scott Key Bridge affects energy trade. And that's how it affects markets. All right, the biggest effect, according to the Energy Information Administration, will be the coal markets. The Port of Baltimore stands as the second largest exporter hub for coal in the United States, representing 28% of total core exports in 2023, according to the Census Bureau data. What if energy prices, which are related to crude oil energy, which all energy prices are really intertwined, and they cause an inflation pain. Crude oil prices are significantly down from the peak of 2022, but however, recently they've been starting to tick up. I mean, look at the 3-month, up 16.53%. Year to date, same thing, 1 year, 9.8% up. Coal prices, crude oil prices could have a major effect on inflation ticking back up. That's why the Fed is likely going to err on the side of caution of they don't want to cut rates prematurely because then we got to fight inflation all again. And it's going to be a worse fight. It's going to be rates having to go even higher, so they have to defeat it now. They can't cut rates too soon. So what are they going to look for? They're going to look for weakening economic data. That's what they're going to look for. That's what they're looking for to confirm their interest rate cuts. If we don't get weakening economic data, which is a good thing for the economy, if things keep going strong and inflation's still coming down, that's fantastic. That means we did achieve the soft landing. However, with them forecasting rate cuts, I think they believe that the economy is going to slow down and they're going to be forced to cut rates. They have, from this year going into next year, at least 5 interest rate cuts. And they don't do that unless the economy is weak. So stick with us. We'll talk about more inflation. What does the Fed say next week? We got some important events taking place, so stick with us. Expertise you deserve, experience you can count on.